Well, good morning, everyone. Thank all of you for being here today, and welcome to the Chamber Forum. I'm Roy Williams. I'm the President and CEO of the Greater Oklahoma City Chamber, and we're really thrilled to have you join us now in our third forum for this year. We listened to our members. We heeded their call, who said that they wanted the Chamber to provide timely, relevant programming on news and issues impacting our community. So that's why we're here. We're providing members with these monthly opportunities to hear various topics of activity in our community. Before I introduce our guest, I'd like to take a moment to recognize today's signature sponsor, Cox Business. So please welcome Eddie Blankenship, Cox Business Sales Director, to the stage to say a few words. Eddie?
Good morning. My name is Eddie Blankenship, and I wanted to welcome everybody and thank you for coming out today. I know it is spring break for a lot of people, so the roads were quite empty for some of us this morning. Cox Business is a proud supporter of the Chamber, and we're also a proud supporter of our small and medium businesses throughout the Oklahoma area. The topic today that Mark is going to hit is, it's important to a lot of people, and we want to make sure that as we look at the new tax laws, that we focus on how that's impactful to the small and medium customers throughout our community. So again, thank you for having us, and thank you for having Cox sponsor the event.
Thank you, Eddie. I also am pleased to recognize our corporate sponsors for this event. That's ADG Incorporated and Guernsey. So help me thank them for being corporate sponsors. So, as all of you have heard, the recent federal tax reform overall is probably the most significant change to our nation's tax laws in over 3 decades, over 30 years now. So whether you're small or you're large or whatever, really every business is going to be impacted by this new law. And if you haven't been made aware of it, the new law is only 479 pages. So I'm sure all of you have looked through it, and you probably won't need a whole lot of insight into it, but it is rather daunting. And we all know how difficult it is to even understand it if you can read it. So we're really pleased to have a local expert here today with us who's really going to dive into it, address some specific areas of that. But we're going to do that after lunch. So please enjoy your lunch right now, and then we'll be back in a few minutes, and we will regroup. So enjoy it. Thank you. Feel free to continue eating. We want to start just a little bit early because we assume after a presentation by our speaker there's going to be some questions too. So we want to try to allow enough time. So please feel free to finish. Our speaker is Mark Whitman, and Mark is a tax partner and a tax location leader in EY's Oklahoma City office. For those of you who don't know what EY is, Ernst Young. He serves clients in Oklahoma City and throughout the entire Southwest region. He has more than 19 years of experience working with public and private companies in various industries, with a primary emphasis in the energy sector. So please help me welcome Mark Whitman to the stage. Mark, it's all yours. Come up and
Thank you, Roy. Well, first of all, I want to thank the Chamber for giving us the opportunity to come speak to you today about tax reform. It's something that me and my colleagues have kind of lived for the last 18 months or so as President Trump was elected, and it looked like we would likely have some sort of significant tax legislation, and we followed it throughout the last year, and then ultimately in December when the legislation was passed and signed into law. So happy to be here to talk to you about tax reform. One quick item that my professional standards require me to cover is that this is for educational purposes only. So anything we talk about today should not be construed as tax advice or accounting advice. So I strongly encourage you to reach out to your own tax advisor on any particular issues that we talk about that you see as being significant to you individually or the businesses that you own or work for. So we've got the agenda today. What I like to do when I do these presentations, and I've done them for years, is when I talk about tax policy and changes in tax law, I like to kind of set the stage with reminding everybody that tax policy is not just economic policy, and it's not just political. It's kind of a combination of the two. So it often helps to kind of think about the economic and political landscape that we're in before you kind of dig into the details of tax reform or tax policy. So kind of where we stand now in the last several years is the economy is generally considered nationally to be doing fairly well. GDP growth has been between 2 and 3%. We've got the unemployment rate that's been steadily declining since the Great Recession, and it's projected to continue to decline into 18 and 19. Down towards the bottom of the slide, we see that a couple of things are starting to change with respect to prices, the general inflation environment. There's an expectation that inflation might have an uptick in 18 and 19. And then also interest rates are starting to tick up a little bit from where they've been at historically low levels the last few years. This next slide is a good one to set the stage for kind of what federal tax policy looks like as a whole. This is actually fiscal 2017, so this is before the tax reform that we're going to talk about in a few minutes. But the left side pie graph shows you the sources of revenues, and then the right side pie chart shows you the expenditures of the federal government. I think key takeaway on the left pie chart is that between individual income taxes and Social Security taxes, so taxes either paid by individuals or paid on behalf of individuals, makes up about 83% of the federal revenues. So that's kind of where the money is as far as if you're going to raise taxes or lower taxes, it usually ultimately falls on individuals. Some of the taxes you hear a lot about in the media, things like the estate tax, are so inconsequential on that pie graph that they don't even have their own slice of pie. They're buried in the other category that's less than 6% of the pie. On the expenditure side, if you look at that, if you really dissect those different sections, what you'll quickly see is most of the areas with significant spending are the areas that are really hard to change without significant political implications. Things like Social Security, Medicare, defense. The non-defense discretionary in the kind of upper left-hand corner of that pie chart is only about 6% of the federal budget. So when Congress is trying to balance the budget, they've got some really hard choices to make. And as you can see in fiscal 17, as we all know, the federal government ran a pretty significant deficit of just around $700 billion. So this is a snapshot of what changed in December. I'm not going to talk about it much here because we're going to have some slides on some of the more important provisions of the law, but wanted to just see the laundry list of things that changed both for individuals and businesses. And then, so that was in December. Then we got to February, and we had the Bipartisan Budget Act of 2018, and that's where Republicans and Democrats got together in Washington to tackle a few of the tax policy issues that for one reason or another couldn't be addressed in the Tax Cut and Jobs Act, but then also talk about increasing defense spending and then also non-defense discretionary spending. And the net result was a $320 billion increase to our federal deficit over the 10-year budget horizon. This next slide kind of goes through what our deficit and federal debt is projected to look like over the next 10 years. And this is post-tax reform. This is actually from the administration, so you'll see some other stats out there that might be put out by the Congressional Budget Office or others that might look a little bit different than this. But according to the administration, the federal deficit in the near term will uptick to close to $1 trillion for several years, but then will level out and start to decline over the 10-year budget horizon. And then what I think is probably the more important aspect of the slide is the bottom part, which is the federal debt as a percent of GDP. You hear a lot in the media around what the total amount of federal debt is, and they can be pretty staggering, trillions and trillions of dollars. And in absolute dollar terms, those can be kind of scary. But when you look at the federal debt held by the public as a percentage of GDP, you can see, at least based on current projections, those numbers are not expected to go up over the long term, but actually will decrease during the 10-year budget time horizon. And that's really what can be important. What economists tell us is important is not so much the absolute dollar amount of the debt, but how does it relate to the size of your economy? So as long as the economy is growing, the debt has some room to grow without causing significant harm to the economy. And as I said, so tax policy is not just economic policy, it's also based on political realities. So just kind of a quick snapshot of what the political landscape looks like. As I'm sure everyone in the room knows, the Republicans control both houses of Congress and the presidency, but we're headed up towards a midterm election cycle. And historically, whoever holds the White House historically loses on average 30 seats in the House in the midterm elections. And if the Republicans were to lose 30 seats in the House in this upcoming midterm election, they would lose the House and it would move to Democratic control. There's also a few things with regard to the House that also would make it look like the Republicans might have a harder time this year retaining control, and that's there's substantially more Republicans either retiring or seeking other office than there are Democrats. I think it's 36 to 15 or so. And so it looks like there's a real likelihood that the Democratic Party could take control of the House, which would obviously impact any additional tax legislation under the Trump administration. The Senate's a little bit different animal. It's currently a lot closer, 51-49, but the makeup of who's up for election in the Senate is quite a bit different. You know, the Senate's on a rolling cycle of every 2 years, roughly a third of the Senate is up for re-election. And it just so happens for this midterm cycle that 26 either Democrats or independents that caucus with the Democrats are up for election, and only 8 Republicans. So not saying that the Republicans will definitely retain control of the Senate, but the math is a little bit more in their favor in the Senate than in the House. Kind of moving on from the political and economic landscape, let's talk a little bit about the tax policy reforms that we just had. And I think you can really boil the tax reform debate over the last year and what we ultimately had into three segments. There was a real push to broaden the tax base and lower tax rates. And we'll see throughout the discussion of the specific policies how that came to pass. There's also a real push to fundamentally reform our taxation of companies that have international operations. The U.S. was one of the last significant economies in the world that taxed worldwide income from our international companies. And with the tax reform, we've now moved to a more territorial system that we'll talk about a little bit more in a minute. And then as soon as the president was elected, we started hearing that tax reform was intended to be a tax simplification, to make it simpler for people to file their taxes. And I can tell you, having spent the last several months reading what we ended up with, by and large, that was not accomplished. There are some really complicated aspects of the tax reform legislation, but there are some pockets of simplification, especially for lower and middle income folks. There will be some simplified aspects, but for more sophisticated taxpayers, higher income taxpayers and businesses, there's some real complexity to what was just passed. Going to advance this, there we go. So again, to talk a little bit more about the concept of broadening the base and lowering the rate. The U.S. federal and state combined income tax rates on corporations had really gotten out of balance with the rest of the industrialized world. This chart kind of shows, going back to the 1990s, that the U.S. combined federal and state income tax rates have really bounced along just under 40% for that entire time period. But both the G7 and G20 countries, the countries that we compete with and trade with, have steadily declined to where we were substantially disadvantaged when businesses were looking to locate their new facilities, new investments. The U.S. had really become out of balance with the rest of the world. This is just another slide illustrating that point, going from 39% of a combined federal state rate for corporations. Post-tax reform will be more around 26%, which puts us much more in line and kind of in the middle of our trading partners and other significant economies around the world. And then this slide kind of shows at a high level the winners and losers of the different segments of the economy. So businesses have kind of a net tax cut, but within that, there's tax increases and tax decreases, but overall a net tax cut. Companies with international operations will have a net tax increase, and that in large part is due to the transition tax that I'm sure many of you have heard about, where companies with international operations are kind of paying a toll charge to go from the old system of a worldwide taxation regime to a new system that's more of a territorial base. So even though it's a tax increase, most international companies will tell you they're very happy that we're moving away from the system we had before. And then individual taxation is a net tax decrease as well. And so the total cost of the Tax Cut and Jobs Act that was passed in December is about just under $1.5 trillion over the 10-year budget horizon. But then when you do dynamic scoring, when you factor in the expected economic growth that will come from lower taxation rates, you get to closer to a little over $1 trillion or $1.1 trillion of net impact to the budget over the 10-year horizon. So let's talk briefly about some of the significant provisions. Talked quite a bit about the corporate rate being reduced. Another key point for corporations is the alternative minimum tax was repealed for corporations. So this is one area where that theme of tax simplification really held. That was a significant burden for taxpayers to keep track of essentially two tax systems, and so for that to go away for corporations is a simplification. The next bullet, interest expense deduction. Companies that are highly levered are no longer going to necessarily be able to deduct 100% of the interest they pay. There's a formula now that will limit that interest expense deduction to 30% of a concept called adjusted taxable income. Taxpayers don't lose that interest expense deduction forever, but it delays when they can take that deduction. And then the last bullet point is something that we often call bonus depreciation or immediate expensing of capital investments. This is a concept we've had in the tax code really for 10 or 15 years. It's come and gone in different forms. This is actually pretty popular within both political parties because it encourages investment, and it'll allow 100% expensing for most industries between now and 2023, and then it'll start to phase down over time, barring some other legislation that extends it further. Net operating losses is another area that's changing. Historically, companies that generated tax losses could carry those losses back for 2 years and generate and get refunds of the tax dollars paid in those years, and then they could carry forward that loss for 20 years. The new rules will no longer allow carrybacks to recover those tax payments in the previous 2 years, but it will allow an unlimited carry forward period. However, when it's being carried forward, it will no longer be allowed to offset 100% of taxable income. It'll only be able to offset 80%. So it creates kind of a minimum tax concept. I think in the interest of time, we'll have to skip some of these. The research credit in the middle here is another one that's really popular among Republicans and Democrats, so we often see it renewed. It's a pretty expensive provision as far as a budget window, so it's rarely extended forever, but it was retained in the law. And then the bottom one, the domestic production deduction, was eliminated, and this gets back to that theme of lowering the base, or I'm sorry, increasing the base and lowering the tax rates. This is a very targeted way of reducing rates for manufacturers and other companies that produce things domestically, but with the overall rate reduction, it was seen as redundant and something that needed to be a pay for for the larger reduction in rates. During the debate, there was some talk of eliminating quite a few of the federal credits, again, to work on broadening the tax base. But at the end of the day, some of the more popular and significant credits, like the Work Opportunity Tax Credit, New Markets Tax Credit, Low Income Housing Credit, were all ultimately retained in the legislation. On this next slide, I think the middle provision is really important to us here in Oklahoma. For the last 8 or 9 years, when I've given similar discussions to groups, I've always had 10 or 15 slides in my deck about how the energy provisions that are favorable to the energy industry were up for repeal. The prior administration, every year when it put out its budget, sought to repeal basically every favorable energy provision that the energy industry enjoyed. And so for years, I thought those slides would come out of the deck because they would ultimately be passed. But they actually survived, and then they survived again during the latest round of tax reform. So things like expensing intangible drilling costs that are really critical to oil and gas investment were retained. This next slide talks about the pass-through deduction, and this was a provision that, we talked a lot about the corporate rate being reduced significantly down to 21%, which generally impacts larger businesses more than small and mid-sized businesses. And the legislators got together and said, hey, we can't have all of this tax reform only benefiting the biggest companies. We really need something for companies that are smaller and mid-sized that tend to be operated as flow-through businesses where the income flows through to owners and is taxed at individual rates. And that's where we got the pass-through deduction. This will end up being one of the more complex areas of the entire tax reform. For those of you that either own flow-through businesses or work for flow-through businesses, I highly encourage you to get with your tax advisor and start parsing through how this will apply to your particular fact patterns. It's a real complexity here. And then some more discussion here around, there's also some changes to how executive compensation is taxed, generally unfavorable to executives. Usually companies that have this issue know they have it because it impacts the C-suite, so people are well aware of it, but wanted to point that out in case it you hadn't heard about that yet. So that kind of moves us through the business provisions, and thought we'd spend a little bit of time talking about what impacts everybody in this room from an individual standpoint. Individual tax rates were decreased, and you can see the rates there on the upper left-hand corner, not reduced as significantly as the corporate rate. But if you remember back to the pie chart we started with 83% of federal tax revenues coming from individuals or taxes paid on behalf of individuals, small changes in the individual rates can have drastic impacts on the federal budget. And I think that's probably why we didn't see as drastic a tax cuts as we did on the corporate side. Another big one is the state and local tax deduction. So individuals will no longer be able to deduct an unlimited amount of their state and local income and property taxes. That'll be limited to $10,000 going forward. The AMT, as I said, was retained for individuals. So this was an area that I thought there was a real opportunity for real tax simplification that we didn't get. AMT is still applicable to individuals, and that creates some real complications for especially for individuals with flow-through businesses and different businesses flowing through to their individual return. And then the mortgage interest deduction was retained, but for a period of years through 2026, new purchases of homes will only be able to deduct up to $750,000 or interest on $750,000 of debt. A few other things. The upper right-hand corner, the estate tax was retained, but the exemption for estate and gift tax was doubled to $10 million. There's an increase in the child tax credit and an adjustment to the phase-out range for that. And then the ACA, the Affordable Care Act individual mandate, was effectively repealed. It's technically still on the books, but starting in 2019, the penalty will be zero, which effectively repeals it, barring further government action on that front. Charitable donations are still fully deductible, and in fact, the provision on how much the taxpayer can deduct got a little bit more favorable, going from 50 to 60% of their adjusted gross income. Change to 529 plans, still intact, but it actually becomes more favorable for individuals that are sending their kids to primary and secondary school to private schools. They can now withdraw up to $10,000 a year per child out of their 529 plans and spend that on their private school tuition. Let's see what else we got. Go to the next slide. Favorable capital gains rates were maintained in the legislation. Gain from the sale of principal residence. There's a point in time during the negotiations that provision looked like it was going away, but it was ultimately retained as it existed. And then, as I said, the international provisions are really the most fundamental aspect of reform. A lot of the other things we've talked about are rates changing or policies being tweaked one way or another, but the change in the international tax regime is really fundamental, going from the worldwide taxation regime to a territorial regime. Probably beyond the scope of what we have time to get into, the individual provisions here. But if you have a company that has international operations, this is an area to spend significant time understanding how it impacts the business. I'll be going backwards here. Okay. So then kind of one more, before we get into what we recommend companies and taxpayers do, one more bar chart here to kind of show the top 10 tax expenditures. And so I need to kind of explain what a tax expenditure is and from a federal government perspective. And it's really a tax policy that reduces revenue to the government. And you'll see most of these impact individuals. The top one, which is a $3 trillion item over the 10-year budget horizon, relates to employer contributions to medical plans. So this is our system in the U.S. of companies essentially funding some or all of the medical insurance premiums of their employees, and that being tax-free to the employee. So a $3 trillion item over 10 years. A few of the other ones, capital gains rates is another one, that's the fourth one down. Defined benefit plans is another one on the list. So again, you'll see that most of these really expensive tax expenditures relate to individuals and how individuals are taxed in our system. Kind of just quickly moving into what you should do with all this. And I would say the top item is really the one that in some ways applies to all of them, but really we're recommending our clients model out what this means to their business. For individuals that have more complex situations, for them to model out what it means to their personal tax situation. Because really when you get into the modeling, what you'll find is the Tax Cut and Jobs Act came together so quickly, not every detail was necessarily thought of. And as you start to model out what it means to you, what we're finding is not every taxpayer has an answer to every question that comes up in that. But it's important to get in front of those things, both to be then watching for additional guidance from the government, but then in some cases being in a position to influence Treasury and the IRS with the regulations that will come out to have a voice in how they answer some of these currently unanswered questions. The other items on the list, the next couple talk about the tax accounting implications. So companies that have financial statements need to figure out how tax reform impacts the accounting in their financial statements. Most companies have probably done a lot of that at this point. And then foreign companies need to be looking at their earnings and profits for the transition tax. Review executive compensation programs. And then there's still an opportunity for companies that, because of the significant change in tax rate, there's some planning that can be done around accounting methods to push deductions back possibly into 2017 when you get a better benefit at the higher tax rate, or possibly delaying revenue to 2018 at the lower tax rate. So that's another thing for companies and businesses to take a look at as we sit here today. Then real quickly, from a state standpoint, almost every state income tax system starts with some version of federal taxable income as the starting point for the state calculation. And so with the concept of broadening the base at the federal level, states will sort of naturally get a benefit of increased revenue over the next 10 years if they don't do anything, because states aren't automatically going to reduce their rates. So what our firm has calculated for a state like Oklahoma is, without any change, the broadened federal base that you start with will increase revenue for Oklahoma by about 13% over the next 10 years. But again, as far as actions to take, if you work for a multi-state business, you really need to look at how these changes at the federal level impact your operations and your tax liabilities in each of those businesses. Then just last slide here, for those of you that really like this stuff and want to dig in more, our firm has a website, www.ey.com/tax reform. Has a lot of great materials. Some of it's more industry specific, so things specific to the energy industry or manufacturing that you can go to. There's also ways to sign up for tax alerts to stay updated on as the government kind of digests the law and starts to issue additional guidance. There's ways to sign up to get alerts on that, so I encourage all of you to go to that website if you're interested. I think that concludes the prepared remarks.
Yeah, we're going to transition over there. I'm going to ask Mark a couple questions, and then we'll open it up to each of you. So if you want to go over there.
Oh, sure.
Seat. So we're going to take a little bit deeper dive into some areas that we think maybe there's some commonality in the room, and then, as I said, take some questions from each of you individually. So, Mark, the first thing is, how can a business take advantage of special employee-related credits to help reduce the costs of compensation?
That's a great question, and it's an area where there's a lot of nuance and different ways to tackle that. I'll focus on just a couple. From a federal standpoint, there's the Work Opportunity Tax Credit. That is a credit that encourages businesses to hire what's deemed kind of hard to hire groups, things like disabled veterans, people that are on food stamps. There's actually 10 categories of individuals that this credit encourages hiring. And especially for companies that hire a lot of people and have some level of turnover, it can be a pretty lucrative way to offset some of the cost of hiring those groups. And then in Oklahoma, we have what's called the Quality Jobs Program, which is more of a grant program that you apply for. But if you're a business that's expanding in Oklahoma, it's something that's definitely worthwhile looking into and seeing if the expansion that you're doing might qualify for that Quality Jobs Program.
If a company was potentially going to go into transition, maybe in talks of selling or something like that, is there anything that they should be aware of that might be impacted? Yes. With respect to tax reform, there's not a lot that changed there. If it's a company that is partly employee-owned and some of that ownership came from providing services, there were some rules in the tax reform legislation around what's called carried interest that they need to look into that might be different in 18 than it was in 17. But I think for this room, what's maybe most important is the Oklahoma legislature is looking at potentially eliminating the Oklahoma capital gain exclusion, which has been a pretty favorable provision for Oklahoma-based businesses that if it's not law yet, but if it were to pass, my understanding that would change July 1st. So if you're deep into talks of selling your business and it's an Oklahoma business that would otherwise qualify for that exclusion, you might want to time sort of the final sale of that to try to get before that law changes. There were items in there that were talked about, some being having different expiration dates, yes. Some being corporate provisions, some being individual. Could you kind of clarify that? Sure. So, nothing in tax policy is permanent, I would say, but it is at certain times either permanent or not permanent. And from a corporate standpoint, most of the corporate provisions, but not all,
tend to be more permanent, whereas the individual provisions tend to be more ones that sunset over the next 5 to 7 years. So it really depends on the particular provision that you're talking about, but that's sort of rule of thumb how it fell out.
Good. How does this all impact state and local tax deductions?
Yes, so that's really one of the biggest changes impacting individuals is that limitation of state and local taxes only being allowed to be deducted up to $10,000. Oklahoma is considered more of a low tax jurisdiction, so it probably won't have as much impact in Oklahoma as it will in some of the higher tax states that tend to be maybe more on the coasts. My understanding is there'll be some individuals that change alone will be the difference between them getting a overall tax cut from the reform versus a tax increase, so pretty significant.
You had a slide up there where you showed the economic impact of all this. So say a little bit more about that. What's it going to do to the economy?
Well, as a tax accountant, I'm not maybe completely qualified to answer that, but I'll give you my opinion anyway. I think in the short run, the tax cuts will be beneficial to the economy. I think most of the economists agree on that. What I worry a little bit about is I think the longer term, making sure that we stay in balance from a federal government standpoint, that federal debt as a percentage of our GDP doesn't start to increase too much over time, which really comes down to whether the economy does grow or not, because growth in the economy kind of cures all on these things. But by and large, I think it's going to be beneficial.
Sort of toward your last slide, you talked about what do we do now. So is there any other thing you want to say about what can each of us do now to prepare for the new tax rules?
Yeah, again, I think it's just a matter of sitting down and modeling out what it means to you or your business. For some, that'll be a pretty quick exercise. If you're more of a W-2 employee, not a lot changed for you, but if you own flow-through businesses or work for flow-through businesses or corporations, you really just need to sit down and probably get with a tax advisor to really parse through how each of the changes impacts you. Identify those areas where it's not clear how they impact you, and if you have a voice in the political process, get involved to try to influence what the regulations say, what maybe technical corrections from Congress might say in those regards. So I think that's the key takeaway.
Good, terrific. Well, we want to open it up to you now for any questions you might have. We have a staff person that has a mic, so if you'd raise your hand, she'll scurry over to you. No questions on taxes? Oh, yeah.
I've got a question with regard to people with pass-through income. You mentioned that a number of deductions, like the interest deduction, deduction on taxes for individuals won't be allowed, but for pass-through income, for example, if you have property taxes on a building, because I'm in the real estate business,
yes,
and interest on a building and it's passed through, are those deductions affected by this law?
If you have property taxes within a business, I believe those will still be deductible within the business. It's more when you have taxes that flow out to individuals. So for instance, if you have a pass-through and you pay state income taxes at the individual level, that's where that limitation is going to be an issue. But the property taxes in the business, I think you should still be able to fully deduct.
Maybe I didn't read it completely clearly, but you had a couple of lines there on the change of Section 179.
Yes.
And you referred to $1 million. Can you explain that? I just didn't.
Yeah, so Section 179 is a provision geared towards small and mid-sized businesses that allow for the deduction of capital improvements or capital expenditures. It becomes a little bit less relevant when you've got the overall immediate expensing regime or bonus depreciation. But bonus depreciation is scheduled to sunset over time, whereas 179 is a permanent item. But the way 179 works is as long as you place in service less than, I think it's $2.5 million in a particular year, then the business can deduct, without getting into the depreciation rules, $1 million. So it's a way to encourage investment by small businesses. But again, it's not really as relevant right now with the overall immediate expensing regime.
With respect to the QBI deduction, for individuals that have multiple pass-through entities, I get that individual only gets one 20% deduction at the end of the day, but the limitation of the 50% of W-2 wages or 2.5%, 20%, do you test that at, say, the 1065 level, or do you test that as a conglomeration of all of that individual's pass-throughs?
Right, it's a great question. And this is one of the areas that's going to require clarification. So I think as it's written now, there are limitations at each pass-through level, but then there also are there's some interplay when it gets to the individual on if you have excess, in one and maybe deficit in the other. So that's where this gets really complicated really quickly, and we're doing a lot of modeling with our clients to try to isolate what the range of possible outcomes on that is.
One of the changes in the new law that I hear a lot of people speaking about today or commenting about is the elimination of the remaining business and entertainment expenses that existed, the last 50% that's going away.
Right.
And I was wondering what you're hearing from some of your clients about that being eliminated, or are you sensing that some companies are going to make changes within their own organizations about minimizing those types of expenses in the future?
Yeah, I think it will have an impact. I think companies are going to revisit what entertainment expenses they're kind of willing to reimburse if it becomes when it becomes fully non-deductible. So I think it'll have an impact. I personally haven't done a lot of work on it yet. It seems to be maybe not the very first thing companies are addressing, but I think we'll see it addressed here over the next few months. I think up until this point, especially larger companies, I mean, they've been really focused on just trying to get their financial statements right for 2017. And now we're starting to see more of the modeling. Okay, what does it mean for me for 2018? What does it mean for my non-tax, just business policies? And I think we'll see some changes around what entertainment is they allow their employees to do, since a lot of that will be 100% non-deductible now.
No other questions? This is your chance for free tax advice.
Yeah, it's not advice, that's right.
Yeah, no, that's the disclaimer.
Educational purposes only.
Yeah, for some free tax education.
That's right.
Yeah.
Yeah, so they didn't change as fundamentally as what some thought they might change, but the primary change is that if it's considered a carried interest, that rather than having to hold that interest for 1 year to get the favorable capital gains rates, you have to hold it for 3 years to get the favorable capital gains rates. So not a complete sort of repeal of being able to get to capital gains treatment, but it makes it a little harder and requires those employees that might have the funding to wait a little longer to enjoy those lower rates.
I just had a quick question about the some of the tax credits and so forth that are available. How are they applicable to nonprofit or not-for-profit organizations?
That's a good question. So, I mean, generally speaking, nonprofits are not going to be paying tax unless they have an unrelated business income stream. So if they're involved in something that doesn't qualify under their tax exempt status. And I think once they're into those unrelated business income rules, most of the credits are going to be applicable because they're taxed almost like a corporation. But I'd probably need to look into any particular credits you're talking about to be sure whether they would apply to that situation. I'd have to look at that, actually. I'm not 100% sure how that applies when you're in that unrelated business income sort of realm. So I have to check on that.
Any others? Well, help me thank Mark. Thank you. Well, I hope y'all have a deeper appreciation for tax and accounting firms now in our region. And should you be in the need for one, don't hesitate to go to our website, look at the chamber directory. We have a number of member firms who can assist you in both individual and business income tax preparation need. So With that, I want to thank our signature sponsor, once again, Cox Business, and our series corporate sponsors, ADG Guernsey. And at next month's forum, we're going to hear updates on the Chamber's criminal justice reform initiatives, particularly that are focused around the newly created Oklahoma City or Oklahoma County Criminal Justice Advisory Council and what's going on with it. So we hope to see you back here in Vast on April the 18th, 3 days after tax day.
Right.
Actually, 2 days, because I think it's the 16th now instead of the 15th. So thank all of you for attending. We are adjourned.